All right, today we're going to tackle one of the most powerful and, let's be honest, often misunderstood tools for building wealth: stocks. So, whether you're just starting out or maybe you just need a good refresher on the basics, we're going to break it all down for you. This quote really nails it. At first, the whole idea of investing can feel, well, a little wobbly. It can even be pretty intimidating, right? There are so many confusing terms, and it seems like there are risks everywhere you look. But just like learning to ride a bike, once you get the hang of the basics and get a little practice in, you can take those training wheels off and really start to build some momentum. It's all about mastering the fundamentals first. So that's exactly where we're going to start, with the training wheels on. These are the absolute must-know concepts you need before you even think about starting your investment journey. And, it's super important to understand this from the get-go. The road ahead is going to change. Some days will feel like a smooth, easy ride downhill, and other days, well, they might feel like you're pedaling uphill into the wind. That's just part of the ride. Okay, now that we've got our mindset right, let's get to the real heart of it. We hear the word stocks thrown around constantly, but what is a stock, really? At its core, a stock is simply a piece of a company. Yeah, that's it. When you buy a stock, you're buying a share, a tiny slice of ownership. This means you actually own a fraction of that company's assets, and more importantly, you get to share in its future success. You have a claim on its profits. So, how does owning this tiny piece of a company actually make you money? Well, there are two main ways. The first is what we call stock appreciation. That's just a fancy way of saying the stock becomes more valuable and you can sell it for more than you paid. The second way is through dividends, which are basically like profit-sharing payments that some companies send out to their shareholders. Okay, so that's the theory. But how does this all play out in the real world? Let's use a quick example to see how all these pieces connect. Let's imagine a company. We'll call it Bull Flag Cycling. They make incredible bikes. So incredible, in fact, that they can't keep up with demand. They want to expand and sell their bikes all over the world. But here's the thing. That kind of expansion costs a lot of money. They need to raise cash or capital to build new factories and reach all these new customers. So what are their options? Bull Flag Cycling basically has a big choice to make. They could go to a bank and get a massive loan, but that means taking on a whole lot of debt. The other option? They can issue stock. This lets them raise the money they need by selling off tiny pieces of ownership to investors, all without going into debt. And this is where our investor comes in. Let's say you've got some extra cash and you're looking for a better potential return than what you'd get in a boring old savings account. You do your homework and you decide that Bull Flag Cycling has a really bright future. You think it's going to grow. So you're willing to take on a little risk for that potential reward. Okay, let's say Bull Flag Cycling needs to raise $1 million. They decide to go public and issue 1,000 shares of stock. Now, this very first time they offer shares to the public, that's called an initial public offering, or IPO. You've heard of that, right? Well, the math is simple. $1 million divided by 1,000 shares means each share is worth $1,000. And our investor, they decide to buy one share for that price. And just like that, the training wheels are off. The investor owns the stock, and now we're on the open road. This is where those good days and bad days we talked about earlier really come into play. From this point, the investment can really go one of two ways. On the upside, if Bull Flag Cycling does great, its profits grow, the company becomes more valuable, and so does the stock price. Our investor can then sell their share and make a nice profit. But on the downside, if the company struggles, its value and its stock price could fall, and that could lead to a loss if they decide to sell. So here's the key takeaway. While the goal sounds super simple, buy low, sell high, the reality is that stock prices don't just go up in a nice straight line. They can stay flat, they can go down, and they can change really, really quickly based on pretty much everything, from company news to what's happening in the wider economy. And that volatility is exactly why you can't just hop on the bike and hope for the best. You gotta have a plan. You need to know how you're going to navigate the road ahead. And this really brings us to the fundamental trade-off in all of investing. Stocks are generally riskier than other investments, like bonds. So why would anyone take that risk? Well, because with that higher risk comes the potential for much, much greater rewards over time. Smart investors manage this risk with a whole toolkit of strategies. And maybe the most important one is not putting all their eggs in one basket. They diversify. They invest across many different companies and industries. They also create a long-term plan and actually stick to it, which helps them ride out those inevitable bumps in the road without panicking.
So there you have it. You've got the basics to get on the bike. You understand what a stock is, how it works, and the whole risk versus reward thing that comes with it. A journey of 1,000 miles starts with a single step, or in this case, maybe a single share. The real question isn't just what your road will look like, but where you want it to take you.